Good morning, everyone, and welcome to Zonda's final Mortgage Playbook webinar of the year. What a year it has been. My name is Nicollette Chapman, and I am so pleased to be joined here today by Ali Wolf, Zonda's Chief Economist, as well as Kevin Pranio, my friend and Chief Lending Officer at PRMG. Now, before we begin, do note that we talk fast and we cover a lot of ground. So if you miss anything, don't worry. We'll follow up with a link afterwards to the recording. Please submit your questions at any time, and time permitting, we'll answer them live. At the end of the event, please do remember to take some time to fill out our exit survey. Now, who are we? We are Zonda, a housing data and consultancy firm. We track the entire building life cycle from raw land all the way to closeout of new home communities. Our database tracks actively selling communities across the country, and we can tell you who the best-selling builders are and where to find their best-selling communities. Today's event is sponsored by Zonda Mortgage Pro. If you aren't familiar with Zonda Mortgage Pro, this product will work to help lenders secure more builder business by helping them identify opportunities to work with builders who don't have a solid lender relationship. We will work to track market share down to the subdivision level. Simply stated, in addition to helping identify potential builder partners, Mortgage Pro can help you connect with those decision makers in order to help you grow your new build share of the market. We are thrilled to announce the most recent enhancement of Mortgage Pro 3.0, which really helps identify even further opportunities for future supply data, builders and upcoming subdivisions, and our new and improved Builder Profile tab, which gives you a comprehensive view of a specific builder's performance, including closing and future metrics, top lenders by loan type, and more. To request more information or schedule a demo today, please make sure to do so at the end of today's webinar. Let's moving into our next topic, which is market snapshots. Zonda offers complimentary housing market top snapshots for the top 65 U.S. core-based areas. Stay up to date on the very latest market data specific to your new home real estate market. While the robust data points you need may have previously required multiple reports and sources, Zonda has it ready for you today in one place. Please also stay tuned to request your free snapshot today. Introducing Livable, Zonda's reimagined new home listing service. This is simply the most accurate and comprehensive new home listing platform. It's made with builders in mind and is free to list for our builders in their communities, exclusive to new construction homes only. We feature both urban and suburban areas in the United States and Canada. Create your free listing today at livable.com. We are also excited to announce the latest addition to the Zonda portfolio, U-Tours. U-Tours represents the industry's most robust on-demand self-tour solution, making it easy for home shoppers to enjoy interactive, self-guided tours of new homes on their schedule, even early mornings or late evenings. Acquired earlier this year, U-Tours will fully integrate with Livable, Zonda's new home constructions listing sites, and further enhance our commitment to becoming a leading residential real estate technology partner focused on the new home market. Lastly, we are thrilled to announce expanded survey market coverage in 7 different states across the country. For a limited time, we will be offering exclusive early adopter pricing in this market. Sign up now for early adopter pricing at zondahome.com/market-expansion. On today's agenda, we are going to kick the 30-minute session off with an incredibly packed housing update. There's certainly no shortage of items to discuss. We'll then speak to one of the industry's most respected thought leaders in Kevin Pranio, highlighting a buzzed about topic, forward commitments. And so let's start off by allowing me to please introduce our housing guru, Chief Economist Ali Wolf. For those of you who have not had a chance to hear Ali speak before, you are in for a real treat. Ali has been featured on various platforms, including Bloomberg TV and Yahoo Finance, and currently consults the White House on housing affordability. She is a well-respected thought leader and has a bachelor's degree in economics from The Ohio State University and a master's degree from the London School of Economics. Ali just returned from Miami, where Zonda and Livable hosted their first ever Elevate event. I was so sorry to miss out on it due to this nasty bug that's been going out, but I'm certain that she's got plenty to share with us after having attended. And so with that, Ali, I'll turn it over to you.
Awesome. Thank you, Nicollette, and hello, everyone. I'm delighted to be here to go through a very quick housing update, about 10-15 minutes of content here. And where I wanted to start is with the interconnectivity between the economy and the housing market. Because we're in this interesting environment today where good news in the economy has actually been bad news for our space, and bad news in the economy has actually been good news. Now, that's talking about interest rates only, but we know that there's been so much volatility in the mortgage market related to economic data releases. Let's go back to where we were at the beginning of October. We had seen that there was a stronger than expected payrolls report. We had seen this narrative shift that, okay, the Fed can't slow the economy. We're higher for longer. That pushed the 10-year Treasury up. That's when we saw mortgage interest rates comfortably holding in the 8%. Now, since then, we've seen some weaker reports coming out of the broader economy, a little bit slower job growth, slower manufacturing data, and in a good way, slowing inflation data as well. And what this has meant is that the 10-year has come down. And now, instead of talking about interest rates that have stabilized in the 8s, we're talking low 7s. Now, all eyes will be on the jobs report that comes out tomorrow to see if it's a surprise to the positive, or if it's continuing to tell us that, hey, the economy is moving in the right direction. It's not collapsing, but it's slowing, exactly as the Federal Reserve would like to see. But if you look at that backdrop and then you tie it to the housing industry, we've been tracking existing home sales on these presentations, and there's really not been a change over the past 12 to 18 months. We still have existing home sales, the largest share of overall activity, down year over year, down compared to 2019. The reasons behind the drop are the same as they've been, related to interest rates and housing affordability. Consumer confidence, partly because people are saying, I don't know how I feel about the broader economy, but also confidence with the housing market. Do I really want to spend that much money for that house? But we also know existing homes are getting very heavily impacted by the lack of resale supply. 80% of people have that rate locked in below 5%. Now, as we track out active listings, what we are finding is so far in 2023, up through November, we have seen that seasonal lift in inventory where we are above where we were at the beginning of the year. But this still leaves us down 34% compared to pre-pandemic, and even pre-pandemic, we felt that overall inventory was tight. And what this is doing is creating a funneling effect into the new home space. We know that resale inventory is low, but we also know resale inventory is old. This is looking at the median age of the housing stock. And in 2022, the most recent data available, we're tied for the oldest housing stock on record. And it's expensive. Traditionally, the price spread between new and existing homes was 30%, meaning new homes were 30% more expensive than resale. Today, it's 4%. So consumers are saying, all right, I could buy an old and expensive resale home, or I could look at builders where I could get a brand new quick move-in home that I can move into within 90 days, or I can pick my lots. I can pick my finishes. I can figure out a home that really helps me justify buying in today's environment, especially if the builder is willing to offer incentives. Now, we'll talk about incentives a little bit more in a moment, but the key thing is we've had this tale of two different housing markets where we talked about existing down year over year, down from 2019, new home up year over year, up compared to 2019. Now, not immune from the headwinds by no means. We're definitely seeing that the new home market has become more choppy. It's more difficult to secure sales, but all things considered, performing relatively better. But as we look at the data, What should stand out to you as odd is the idea that sales today are outperforming last year. We see that nationally, and then we can track the average sales rate. So if a builder has homes to sell, how well are they selling? Most top markets today have an average sales rate above where we were last year, above where we were in 2019. And yet, affordability is objectively worse today than where we were last year. Why are we seeing that outperformance? Now, the only conclusion we've been able to get to is there's affordability and then there's shock. So let's step back. Someone started looking for a home at the end of 21 because of the tight inventory. They had a hard time securing a home until the end of 22. During that period, payment shock up 60%. Put a different way, if someone started their search looking for a $500,000 home, they got to a point by late 22, they could afford a $340,000 home. That's a different size of home. That's a different quality of home. That's a different location of home. So some people, they maybe still would go through with the purchase. A lot of people moved to the sidelines and said, this is not what I thought I was going to get. So we saw the demand pool come down at the end of last year. And yet for the new home space, at least, we've actually seen some surprisingly better activity than expected. And so this is where we've seen the emergence of all cash buyers. We've seen the emergence of relocation buyers, move up buyers, that they accept that the reality is housing has become more expensive. But during their search, let's say they started looking at the end of last year, they found a home today, they've seen a 10% payment shock. So if their new baseline was starting at 500, they're down to 454. And so to us, this is okay. People knew it was expensive. This is more expensive than where we were, but at least there's more stability in starting your search and knowing where you're going to finish your search. So we can look at the sales rate, but what we think is also valuable is to look at market rankings. That's why we created our ZMR. The ZMR looks at sales across different markets in the country, and we adjust for seasonality. Seasonality looks different in different markets, and so we want to capture that on a market-by-market basis. Then quantitatively, we can come up with a ranking. Let me show you the ZMR in 3 different time frames. This is showing you peak COVID. I don't think anyone will be surprised that every market was overperforming. This is where we were at the end of last year. Remember, there was a very clear east-west divide. Here, Texas, West, every single top market was underperforming. East of Texas, you saw a mix of some markets overperforming, some markets average, and some markets underperforming. As we fast forward to where we are today, we definitely saw a slowdown in October relative to September. We went from 70% of the markets that were overperforming down to about 54%. But still, nationally, the market is called slightly overperforming. Now, I just spent the past week in Florida, and you can see Tampa is in that significantly overperforming category. On the ground, the market definitely feels slower. But no, that slower compared to recent history and slower compared to pre-pandemic are 2 different things. So in Tampa's case, way slower than where we were during the height of the market, but still above that pre-pandemic baseline. And then I'd say very importantly, the ZMR does not account for what it takes to sell a home. So if a builder has to throw a lot of money at the consumer to secure the sale, we count the fact that they secured the sale. And what we're finding nationally is over 50% of all projects are offering incentives. And when you look at these incentives, it's probably no surprise the top 3 categories: mortgage rate buydowns to help those that are monthly payment concerned, funds towards closing cost for those that are perhaps tight on cash, and flex dollars. 34% of all buyers today are buying all cash. They don't want a mortgage incentive. They want something to help deck out their home. But let's go back to that first point. Mortgage rate buydowns. What does it look like? Well, we asked builders in November if they're willing and able to offer mortgage rate buydowns, what can they do on a fixed rate basis? So we're not talking about the adjustable rates, we're talking about the fixed rate. What we're finding is the majority of builders are saying that they can offer a 30-year fixed in the mid 5s to high 5s. 18 months ago, this wouldn't have been that attractive to consumers. But now you have consumers in fresh memory, 8% interest rates, market in the 7s. And so they're saying, okay, it does feel like there's a deal to be had if I go with a consumer. Put a different way, If a consumer was looking at a home, 500,000 new and existing, if they bought with a builder that was offering a buy down, getting them into the fives, the consumer could save $600 a month by going with a builder. That's the same as a car payment for some people that they can get by just deciding where and who they want to buy from. Now, as you look at the market though, headwinds, there's absolutely headwinds. We talked about the confidence in rates, but if you look at total sales, new plus existing, we'll still have, depending on how the year ends, between 4.5 and 4.7 million transactions. That means there were 4.5 to 4.7 million loans to be serviced. Now, as we're looking at this, no, it is way below where we were at the height of the market, but still activity. And to me, it begs the question, why? Why are buyers still shopping today? And from the new home side, it goes back to that funneling effect. Lack of resale supply pushing people into the new home space. But besides that, it's relocating, it's having children, it's retiring, it's marriage, it's divorce, it's all of these things that we classify as life happens. There are times where it makes no sense to reset a 3% interest rate to a 6 or 7%. But if your home no longer fits your life stage or your lifestyle, and you have a little bit of flexibility with your finances, we're seeing people are still going through with that purchase. But we wanted to get a little bit more specific. Which buyers represent the most of your sales? We had to ask this in a builder survey to our builder clients. And the number one answer, boomers. Number 2 most active, Gen X. Number 3 most active, millennials. Then Gen Z coming in as 4. Now, if you look at this, what it's really showing you is those that are still buying today largely will be buying off of some kind of wealth, not just their income. And we know that boomers have the highest homeownership rate. They have the highest share of wealth. Gen X, second highest homeownership rate, then millennials. Now, as we track this out, though, for each of these groups, we know that there's different life stage catalysts driving their mobility or immobility. Let's think about Gen Z. Not many Gen Zs will be of that prime home buying years, or really even at the point to be buying homes at all. But we've heard from the Gen Z that they absolutely want to become homeowners. It's not the same narrative as what we saw with millennials. If you look at millennials, this is a group that even before the pandemic, we felt that these years would be strong because the largest share of the largest living generation are hitting the key life stage catalysts that also traditionally trigger a home sale or purchase. Then you look at Gen X. This group was interesting because we didn't see that much mobility with the Gen X going into the pandemic because they had already secured a home. They were more stable in their jobs. Their kids were probably more established at schools. They didn't have those big life stage catalysts. The big thing driving Gen X is that run up in equity plus some of the flexibility with work from home. And then finally, boomers. Boomers are an interesting cohort. They're moving the most. They're buying homes the most. They're selling homes the most. And a lot of it comes down to their key life stage catalyst, which is retirement. Every boomer will be of retirement age by 2030. And we know that retiring is the third key reason why people decide to move. Now, as we put all of this together, I think an important thing that we understand is more building could help with mobility and affordability. And what we're capturing is that 70% of builders still plan to start more homes next year versus this year, despite a little bit of choppiness in the overall demand backdrop. Now, know that our survey is a little bit more public builder skewed, a little bit more larger builder skewed. BTIG has done their own survey. They find 40% of builders plan to start more homes. So you average that out, you still have a majority of builders that think, hey, we need to continue to build through to provide new homes and backfill some of the communities that we sold out. Now, this does assume that financing remains reasonable to the consumer and to the builder, and it assumes that demand holds up, which we've seen can be choppy based on headlines, based on rates, just based on time of year. But as we put all of it together, we are expecting total housing starts to be down next year versus this year, exclusively led by a drop in the multifamily side. When we look at the for rent space, the capital constraints are hitting that part of the market a lot harder, and we're finding a more pronounced pullback. From the single family side, what we're calling for is 3% growth. Our number is 930. The range I've seen in the market, 880 on the low end, 1.1 million on the high end. Now, once we put forth our forecast, we like to say, hey, what could prove us wrong? What if the number's 880? Well, we, as a key part of our discussion, we believe that builders will be able to continue to offer at least a certain amount of incentives. That's one of the key things that could tilt our forecast to being too high if builders' margin compression gets too severe and they can't continue to offer these incentives. What about too low? We talked about market share. We talked about how new is gaining, and we talked about how the labor market is slowing but still holding up. There are different scenarios too that we see that could actually make our forecast be too low at 930. Now with that, I'd like to reintroduce Nicollette Chapman to go through this discussion on forward commitments and the overall origination market. Now, Nicollette is our Senior Vice President of Mortgage here at Zonda with over 20 years of experience in the mortgage space. In her role, Nicollette travels across the country doing presentations focused on educating loan officers and banks about the importance of builder business. Besides being our mortgage expert here at Zonda, I found out recently Nicollette is also quite the chef. Her husband is British, and for Thanksgiving, she blends the cultures by incorporating homemade traditional British food as part of the feast. So Nicollette, we will take an invitation next year. Let me pass it to you.
Thanks, Sally. I'll have to work on my Yorkshire pudding recipe just a little bit more before I'm opening it up to thanks for that. Great information. I'm absolutely looking forward to asking some questions to our esteemed guest speaker, Kevin Peranio. Kevin, better known in our circles as KP, really needs no introduction as he's really a living legend in our business. Having started his career in 2001 with First Magnus, Kevin has held COO and board member positions along the way to his current position as Chief Lending Officer at PRMG. With 14,000 plus followers on LinkedIn, he is used to having many eyes and ears on him as he shares his weekly videos on his LinkedIn page. Although he lives in Southern California, you'll never take the Texas out of him. So welcome, Kevin. Hook 'em horns, and thank you for being here today.
Hey, thank you for the kind introduction and great information, Ali. That was really eye-opening. So appreciate the invite today.
Well, again, thanks for being here. I know you're having some housing construction going on outside, and kudos to the insulation in your house because you would not even know it. So well built. Was it new construction? I'm curious.
Oh, it was a remodel. The house was gutted to the studs in 2015, and we moved from Fort Lauderdale with 2 girls, a dog, and a cat, and moved in a nice rehab. Thank God I bought in Newport Beach in 2016 because it's a little crazy right now.
For sure, absolutely, as it is in most parts of the country. So, well, let's jump right into it. So, I want to talk a little bit about a buzzword that's been sort of seeping around the industry, and that's forward commitments. And there's a lot of mystery behind them. And so, I want to sort of turn it over to you and ask you simply, what are forward commitments and why are builders finding them beneficial in this market?
Well, the capital markets side of our business is interesting. I have a couple sayings there. So basically, what we do in our industry is we buy and sell money. So when you have a mortgage-backed security, which is seen globally as probably the second safest fixed income asset out there besides U.S. Treasuries. You have a mortgage-backed security that is backed by the home and land as collateral, and you just hope that the borrower makes the payment. And so, that financial instrument in the capital markets needs hedging requirements. There's a long time, when you just a forward mortgage, right? Just a mortgage, the average mortgage for whatever reason, the average from contract to closing is still at a mind-numbing 42 days. That's a lot of exposure to the secondary market. So construction loans have so much more exposure. And this is my other saying, yes, we buy and sell money, but I always say this about the secondary market. It is cold, it is heartless, and it is unforgiving. And the problem with hedging financial instruments, forward commitments, is that you pretty much can't win unless you close it really quick. And so you take out a forward commitment, you take out your cost of capital, you take out a hedge, you want to try and securitize something, then the market moves whether interest rates are getting better or getting worse, the security that you have is out of the money. And so that's a big reason why banks, regional banks, they are typically your major lender when it comes to new construction, because they've got the cheapest cost of funds. I mean, not that it's cheap right now with a 525 to 550 Fed funds rate, but it used to be zero for a long time. But they have the cheapest cost of funds relative to the rest of the market, and they have tons of funds. And then they have other revenue streams to try and make up for a potential forward commitment loss. And so, it's if I'm a bank and I want to help someone with their new construction loan, you're probably going to lose on the actual lock. Either way. Your hope, though, as a bank or a credit union or a regional bank or whatever the case may be, is that you've got, all right, I'm going to get their car loan, I'm going to get their credit card loan, I'm going to get their deposits, we're going to make net interest income off their deposits. There's these other revenue streams to offset, which is almost always a loser, a forward commitment for a construction loan.
Sure. And I think there's probably something to be said about guaranteeing future business when the forward commitment is no longer necessary. Something to be said of, you're there in the muddy waters, let me help you then in the clear waters ahead. So
100%. 100%.
Yeah, definitely. Okay, great. Well, let's move on to the next question, because I want to help people understand, how are those forward commitments structured by secondary? You mentioned that as an industry, we really are just selling money, right? So tell me a little bit about what goes on behind the scenes in order for secondary departments to really structure those forward commitments.
Sure. So I'll just use our company, for example. We're a privately owned independent mortgage banker. We have our own capital. Our founder and CEO, Paul Rozo, we've been in this business for over 23 years at PRMG. All four of us have been in the business a little bit longer. And then Robert Holliday, his co-founder. So they put it up. I've been with the company 13 years. And then we have another partner, Gary Malice, who's over cap markets and strategy. So the four of us, we put money in the kitty and it sits there, and we use that to take out what's called a forward commitment. So I'll use the easier example to explain, which loses money when you see a 90 basis point swing in the 10-year treasury in 45 days. So just see, like, rates are getting better. That's great, but everyone's hedge is out of the money. And you try and make sure you want to pull through those locks that were committed to you to fill these trades. And that's what you do. You take out a trade position. So for example, for Fannie Mae and Freddie Mac loans, they used to have their own mortgage-backed security, but now there's a universal mortgage-backed security. So there's a combined security instrument for both Fannie and Freddie loans, your traditional conventional conforming loans. So let's say we have relationships with broker dealers, and we say, okay, today our lock pipeline, we locked $50 million in Fannie and Freddie loans, and our pull through is generally about 80% from lock. So we're going to take out $40 million in position today of a universal mortgage-backed security. So we literally have traders and hedgers that will say, I'd like to sell to open a 6.5 coupon universal mortgage-backed security, $40 million position. So now you've got this open position on the market, which has value, by the way. So that value actually can go down or up, depending on whether rates move up or down. And so I'm hoping those $40 million in locks out of the 50 fund and close, and I step in that security and I sell it back, and then I buy to close that position now that it's filled with loans. And so that's kind of a general way to do it. So just think of the exposure you have in just 30 to 45 days of having an open position on the market. Like the last 45 days, I cannot overstate this enough. When you see the 10-year treasury move from almost 5 to we're down to like 410, 411, who knows where we're going to end with the jobs report tomorrow, right? If the economy, Ali did a good job talking about, good news is bad news and bad news is good news, whatever, right? And it's true, so if labor continues to weaken, we'll see the 10-year treasury come down even more, which is not great for our forward commitments, right? if I got a borrower locked at an 8% rate from just literally 30 days ago, and they're reading all the news, hey, everything's got a 6% rate now. What's going on? What gives? And then, of course, they blow out that lock and they want to renegotiate, but I still have that position that I sold to open on the market freaking 30 days ago. So I'm out, right? So it's all a risk. And what capital markets people like is for rates to just kind of stay even keel throughout the open position and hedging process, which is even harder to do in new construction. And I'm sure you guys probably have good data on how long construction loans take. They take a long time, supply constraints back during COVID, finding labor and cost of windows and doors go up, and all the different permitting with the local municipality, all the things that go on just elongate that process, and that forward commitment has time decay and erodes value potentially if the interest rates are moving. And they've moved a lot in the last 45 days.
Yeah, it's definitely been 45 days in terms of just watching the yields and watching the treasury. And it's just, so yeah, I'm glad I don't have any money out there in forward commitments. I'll tell you that. So good luck. Outside of forward commitments, what other unique programs are you hearing are being offered to home builders as a point of difference?
Well, it's interesting. This is like home builder day for me. I had a meetup last night at a local area, and there was a gentleman that works for Quikrete, which we all know Quikrete, sack of, concrete, right? But they're also, they're like an 8, 9, $12 billion company. I don't even know their cap, but they also do developing. And so it got, got to hear a lot about what they're doing. And, Ali had a good stat where she said that they projected, the new starts to be down mostly because of multifamily. And this gentleman said that's what they focus on at Quikrete. And he was saying multifamily is kind of tough right now. Well, you know why? Because, they got overbuilt. And there were a ton of starts from 19, 20, and 21. And, you look at new lease and new rental, rates, they're coming down, which is great for the fight on inflation. But as rent comes down, because there's more and more supply of multifamily coming to market, that's great for renters. It competes against new home construction for people that want to buy. So you can't, that's why, you see Goldman Sachs, you see other estimates for next year for home price appreciation to be under 2% for single family, because those two compete with each other. And so, we still think single family resident new construction will be strong next year. Wave of demand as interest rates come down. There are more borrowers that come into play that need a house, and that affordability going. I saw that when rates went from 7 to 8%, 5 million borrowers were priced out of affordability. And since the end of 2021, what the lowest rates in the history was February of 22. Since then, 28 million borrowers have been priced out of the market. And Ali had some great stats there talking about, the age and of millennials. We've noticed the first-time homebuyer age was like 33 a couple of years ago. Now it's 36 because they're getting priced out of the market. So as rates continue to come down, and I don't know where they'll level off. We love obviously the trend that's been hitting. There's a really important factor that really changed the game both to the negative and the positive side for mortgage interest rates. Our government sold a lot of new treasury issuance in the third quarter, something like $2 trillion. And so there was a big spike in rate after that last Fed meeting in September. So we've gone September, we had one last month, and obviously, we've had one that last in November, and we have another one coming up in just a couple of weeks, December 13th. So what was interesting is when the Treasury said, hey, we're going to sell $2 trillion worth of, new treasuries, that's a big factor in mortgage interest rates as well. And the market was just handed this giant, massive glut of issuance because our government just spends, right? And so that forced a little spike in that 10-year Treasury up to 5%. At the end of October, Treasury Secretary Yellen said, hey, in Q4, we're only going to put about $780 billion in new Treasury issuance onto the market. That, together with the Fed not raising the Fed funds rate, and all of this weakening, softening data is why we've had such a volatile move in that 10-year Treasury down from 5 to now, 4.1. I don't know where it is exactly at this moment. So I don't know where it'll level off. The next thing we're all looking at next year is, the Fed said higher for longer. So what does that mean? Because, until there's an actual Fed rate cut, right, where they need to spur economic activity again, or they find that this interest rate, the terminal rate, wherever they end is sufficiently restrictive. I mean, it's harder to get car loans and credit cards and personal loans, not just mortgages, everything interest rate sensitive. And people just aren't spending as much. And now the job market's softening. I mean, gas prices are at the lowest point of the year today. Oil is dropping off. So demand destruction is happening. And so how far will the Fed let it go? And that's what we don't know. But on December 13th, they're going to put out their dot plot, the last one for the year. It's interesting. Every time the Fed has a meeting, they don't always put out their economic projections. They call the SVP. So every other meeting. So in September, they said, we're going to be 5.6 higher for longer. We didn't see anything in the November meeting of where they said, but this next meeting, next week, like literally a week from yesterday, we will have the dot plot. Are they done? Are they going to raise further? And then where do they expect the cuts to come, if at all, next year? And that will move the market again, a week from now, less than a week from now. And so these are factors that help you try and determine, how business is going to be from a rate standpoint. But to Ali's point and to everyone's point, it's seasonally slow right now, but the demand factors, the life events, they never stop slowing down, right? I call it the 7 Ds. We start with deployment first because we put our veterans first and foremost. That causes an event to buy or sell a house. Diamonds, diapers, debt, divorce. I like to say debt again after divorce, but I've already said it once. But then we say downsizing and death. And I've heard diploma, and I've heard dirt. I've heard all these kinds of other ones, but we're 70s, not 80s. So we're going to go with 7. So these things, these waves of demand coupled with lowered interest rates, I think the single family residence market's going to be very strong, especially in new construction next year, and it'll be surprisingly strong. And that just drives home prices up. People want new product. So that's our outlook. That's kind of how we're looking at the broad view of what's going on next year.
Well, great information. Love your 7 Ds. I'm sure I could think of a few extras in there, but I'll save those for another time. In the meantime, I do want to ask you, name something that's going on in our industry that isn't being widely discussed that you feel should be.
Well, you brought up in your last question, how we're, tackling builder business. And, we had a gentleman from Builders Capital on our national retail call for PRMG right before I hopped on this call. And it's really interesting to hear them talk about, private niche builders, which they quoted a stat 55% of new construction for single family is now with the small, the mid-sized builder. And I didn't call that stat out. And maybe it's changed because I thought Lennar and D.R. Horton and then Lennar, just the two were responsible for 52.5% of all new single family residence construction. So, we're trying to get our originator base to find ways to go after new construction lending. The tools that you talked about, the ZMRs and all the different things you were talking about at the beginning, that's great data. Those are great insights, and it gets really granular at the community and local level. And so we're 10xing down on winning local. We think that that's what you have to do as an originator and separate yourself. You have to find a way to help and serve your local community. They're still building in local communities. There's still tons of 7D life events coming together with lower interest rates. So we're doing a lot of, revenue generating initiatives using things like Social Coach, right, to put stuff out on Instagram and, get the social selling going. Because when rates come down, everyone starts to read about it. And, there's a little bit of a buzz. And so we're in the slowest part of the year. January and February aren't great. But when everyone wakes up from their New Year's Eve hangover, they start looking again for houses. And so it may be cold in some markets, so maybe they wait a little bit later. But those translate into contracts, which turn into loans, which turn into fundings down the line. So we really see things picking up next year. First quarter will be tough, but March fundings typically bail out lenders from having a weak January and February. But next week, our company has our budget meetings, and we have 3 channels. So we have a retail channel with about 900 originators through across 200 branches. We have a wholesale channel where we serve local originators that have their own broker shop. And then we have a correspondent channel for those that want to take it beyond being a broker and be a lender and get a warehouse line. We are anticipating no less than 20% growth next year. And that is that could get much higher if the Fed cuts the rates. And I think personally, this is my call, I think the Fed will cut the rates between March and July. The May meeting is sounding like it might be it. And when they are typically doing their cuts at the end of a rate tightening cycle, it is in an election year, which next year is. And their first cut tends to be pretty large, like 50 to 100 basis points. So that could hit us in the back half of the year and free up liquidity and free up that cash flow, and then give us a ton of refinance activity. I'll just leave one more thing here. First-time home buyers, okay, since February of 22, they've been paying a higher rate, and their loan amounts are larger than ever. It doesn't take much to have a net tangible benefit for those borrowers to refinance. And so the borrower psychology in the spring and the first 6 months of 22 was like, whoa, rates are going up fast. I'm going to sit back and let the market crash. I'm going to wait for home prices to come back down. I'm going to wait for rates to come back down. And neither of them happened. Rates went up even further, and they stayed there. And home prices and home price appreciation went up by every single standard that's out there for almost 2 years now. So now the psychology has flipped. We've been elevated, and rates have been higher for longer for mortgages. Prices keep going up. I said a year ago, in November of 2022, so this is your last good chance to get a home price deal, because prices actually did come down a little bit from June of 22 to November of 22. And then they went up. And now this is your second to last best good chance to get a home price deal. You can lock in the price of a new home, a new construction, one time. You cannot do it twice, but you can always refinance your interest rate later. And that is the part that's so critical. So the buyer psychology has changed. Now the rates are coming down. People are watching like, man, I better lock in now.
Yeah. And I think to your point, KP, I think one of the things that builders are really good at is buying down rates. So if rates are your hesitation, they are very efficient sellers. And I think that's helped keep builders at the focus, is whether that rate needs to be bought down to 6% or 7%, or in some cases 5.5%, in order to get buyers off the sidelines. They are ready and willing to do that. One other point that you made that I think deserves sort of a little bit of a spotlight is you mentioned D.R. Horton and Lennar being the good chunk of home building. I want to point out that our data says there are over 32,000 unique builders that are actively closing on homes across the country right now. Those builders all need lenders, right? So when Ali goes out and talks to division presidents across the country, they keep reiterating to us that lenders are more important to them than ever. So now is the time to really invest in your strategy in terms of working with builders. It really can no longer be ignored, with 35% of the total inventory nationally being new construction and no refinance business available. We just don't have the luxury anymore of ignoring the new home market. So thanks for pointing that out.
That's such great data. 32,000 different unique builders. I mean, you guys have a lock on that data. You've done a good job of catering
Come
to
at me,
all
and
those
I'll tell you
markets.
where to find them. Come at me. Lastly, you talked really quickly on rates, and I don't want to spend too much more time on it, but this week was a good week for rates. Today we're just over 7%, actually 7.05%, really close to that sort of elusive 6 handle. At MBA Annual earlier this year, the overarching theme was stay alive until 25. Do you think that's still the case, or do you think that we've changed?
Oh, I hate that. I hate that saying so much. First of all, that's a commercial real estate saying, okay? Because, commercial real estate has a whole different, set of issues to tackle, right? You've got, low occupancy rates, what's going on with these loans coming due in 2024, that if they refinance at what was the current rate, right, they're underwater. So these commercial real estate, companies having to just hand the keys back. And so then here we are, we go to, Philadelphia for the Mortgage Banker Association's national convention. And someone started saying it. I mean, I get it. It rhymes. It sounds cute, but it's such a loser mentality. We are going to thrive next year in 2024 in residential lending. It is a growth year. We are projecting no less than 20% growth for our company next year. Rates are coming down. That's it. It's as simple as that. Rates go up, business goes down. Rates go down, business goes up. It's literally that simple. And with all the new construction, gosh, 30 to 35% of all the housing that's going on out there, it's huge. Now let me just, I know people, I know I see this all the time. When you've been beaten down over and over and over for an extended period of time, it's hard to be positive. It's hard to sit there and go, well, better days are coming. And by the way, it's the holidays, right? It's a tough time for people mentally. It's getting freaking cold and the days are getting shorter. I can't wait for the days to turn around after, was it December 27th, I guess, is when they start turning around, get longer again. But let me just say this. I know that 80% of those that have a mortgage are at 5% or under. But let me just poke a huge hole in the theory that they're never going to sell their house. BS. We talked about the 7Ds. That stuff never stops happening. I don't care if I'm at a 3% rate. If I want to live near the water, or if I have a kid and I need a bigger house, I'm going to pay the going rate. And here's how you poke a hole. And I get it. Money's cheap. I get it. But over time, even someone at a 3% rate builds equity. They build more. At some point, they have enough equity that if they sell the house they're in and then buy that next one, even at a 5.5, 6.5, whatever the rate may be, it makes sense to them. Payment-wise, life-wise, what they get in return. Equity at some point gets large enough to offset wherever the rate is at. And every time rates come down, you get closer to that point. And trust me, I mean, the people are 75% of home sellers end up buying another house. And most people, they sell the house they're in and they take every bit of that asset and put it towards the next house. And so that's going to happen. Don't forget to market to those borrowers that have those rates under 5%. They're looking and they are going to sell at some point. It's not a forever thing.
I appreciate that so much. And we are at time, so I do apologize that we don't have time to open up for questions. If you do have questions, please submit them in the chat. But I do want to take a moment at the end of this to celebrate all of you. It's been a rough year. 50% of the origination workforce has given up on our industry, at least for the time being. Will they be back when rates drop? Probably, but for now they're selling cars or doing something else. So today, at this moment, I want to celebrate you for making it through, for keeping positive, for keeping your eyes open and your ears open and navigating difficult waters in order to survive. So again, cheers to all of you. What an amazing finish to 2023. KP, thank you for joining us today. This recording will be posted on our social channels within the next 24 hours. Please feel free also to visit us at zondahome.com/blog to see other things that are happening, as well as inspirational podcasts. But again, cheers to all of you. Happy holidays. And someone wrote in our chat, and I really like it, do more in 24, and I think we can all do that. So make it a great rest of your year, and please reach out if there's any way that we can help you win more business with builders.